Warren Buffett's rule of 30% annual return per year. Welcome to Cash Street, where cash is always king. When Warren Buffett was only 25 years old, he founded his first investment company, which he named Buffett Partnership. This firm operated from 1957 to 1969 and generated average returns of 29.5% during that period. What's interesting about Warren Buffett's investing strategy is that he employs very straightforward techniques to generate such high returns. Rationality is important when investing. As Buffett insists, it is not a game where the investor with the higher IQ wins over the investor with the lower IQ. So, the key to achieving high returns is being rational, following simple strategies, and sticking to them when times get tough. Now, what I want to do in this video is teach you 7 investing rules where Buffett employed to help create such a high return. Still, I'm not suggesting that you reach a return as high as Buffett's. I mean, he's devoted his life to investing and he's a brilliant guy. Still, if you follow Warren Buffett's 7 investment rules, you can greatly improve your long-term returns. It was a rule Warren Buffett learned as Graham, who later became Buffett's mentor when he first picked up one of the greatest investing books of all time, The Smart Investor. Well, one of the rules taught in this book was pretty simple. This rule convinced Buffett that owning a stock meant owning part of the company and that if the business was doing well in the long run, so would the stock. So look for a company that will lead in the future, have high profit margins if you beat the competition, and love the consumer. You don't need a complicated stock as part of your business. If the business is doing well, it will work. While this might be considered an unpopular opinion of Buffett, most news you consume isn't necessarily regarding investing. As you know, news shows like CNBC, news websites, and financial YouTubers all get paid to get as many views as possible. What they do is they generate so much hype and excitement, and they can create as much news as possible to get those views so they can get paid more. Only about 5% of messages should be paid attention to. But, as Buffett likes to say, so much is being said about markets, the economy, interest rates, stock price movements, and more that the amusing and often irrational behavior of stockholders can also affect fellow owners. Cause irrational behavior, some investors believe that it is important to listen to experts and, worse, consider acting on their comments. Don't worry about the experts and most of the news. Just pay attention to the most critical details. Now, I'm hoping you are already familiar with the power of compound interest. Suppose you receive dividends or capital gains, allowing them to compound and grow like a snowball. In that case, you can earn a lot of money. However, suppose you are constantly buying and selling stocks. In that case, you are not allowing compound interest to work its magic and you will miss out on many returns, just like the blue line. The key to investing is to rarely expect to own higher quality companies for the rest of your life when you buy a stock. This is why people like Warren Buffett have owned stocks like Coca-Cola, Wells Fargo, and American Express for more than 25 years. As the Grateful Fisher states, if the work has been well done when a common stock is acquired, the time to sell is usually never. The wonderful thing about investing is that you're not in it alone. Even Warren Buffett has learned from and listened to other investors throughout his career. When he was younger, he had the investing coach Benjamin Graham who trained him in investing. When he grew older, he always had Charlie Munger on his side to check if he had the proper point of view. The nice thing for us is we've had wonderful investors to listen to and learn from. Warren Buffett can clearly view his whole portfolio and the particular stocks he purchases annually. Ray Dalio currently regularly shares his opinions on CNBC. The same can be said for Charlie Munger, but the important thing is to pay attention to people we already know and trust. Is it vital to pay attention to the CNBC media personality constantly complaining about the latest hype or the popular YouTuber who promotes buying Tesla stock? Do they fully understand investing and the actual value of each stock, and do they only pay attention to people they know and trust? This is a straightforward tip but one which not too many people follow, and that is to comprehend the firm that you're investing in. You know, if we take a look at Warren Buffett's portfolio, one thing that you'll notice is that a lot of firms that he owns are actually quite concise. Coca-Cola is a company that primarily sells soft drinks but also has diversified into the food industry. Selling flights is how the airline firm Southwest Airlines generates revenue. Furniture Mart sells home furnishings. Apple sells iPhones and other digital. If you're interested in vehicles, investigate deeper, including Ford, Toyota, and Tesla. Warren Buffett makes sure that he is capable of knowing the firm before he buys a stock, and you should seldom do the same. If you like online shopping, try Amazon and Alibaba. If you're into the internet world, check out businesses like Alphabet, which owns Google and YouTube. For fairly much every distinct passion or interest, there are stocks out there to be purchased only by companies you know about. This guideline is extremely relevant to today's market situations. You see, the thing about these current economic conditions is we've had a bull market for approximately 11 years now. Stocks had gone up almost 300%. Everyone thinks that they are masters when it comes to the stock market because everything has been rising and everybody is making money. Everyone becomes selfish because they are overconfident in investing their skills, which is one obvious result. Now, what do you expect this to do to stock prices? Well, overinflates prices. Everyone wants to invest in stock values go higher, making it harder and harder each day to find a good deal in the stock market. There are times when we need to be afraid and careful with our investments, and this is precisely what Buffett is doing. He possesses $228 billion in cash and $214 billion in publicly traded stocks. That's a large amount of money in cash. Now he's employing a cautious strategy in these market conditions. You could say he's been fearful, yet you can bet your bottom dollar. That is as soon as panic starts to set in with the stock market. When stocks are discounted, Warren Buffett will start to act on his greed and buy a lot of them. When it comes to investing, if you don't go by this guideline, all the others are useless, and your plan will be fruitless. You must ensure that the price you buy for is below or at an actual value because no matter how good the company is, how good the management teams are, or how much you determine the company, it is not worth the total price. To clarify, let's say you're considering purchasing a Lamborghini. There is no question in anyone's mind that this is a reliable, amazing quality vehicle. Undoubtedly, the designers and builders put an incredible amount of thought and care into creating this vehicle. Still, the key question is it reasonable to pay $350,000? Remember, no car is worth the total price. It's the same with the business flash stock. Warren Buffett says no company, no matter how wonderful, is worth an infinite price. Price is what you pay, value is what you get. And to know the real value of each stock, you must first understand how to calculate it. For this reason, I would advise enrolling in Van Callen's free investing course. He is a reliable entrepreneur, and in this lesson, he gives a detailed guide on investing. Obviously, included in this is how to value stocks and how to get real value. Therefore, you can check this course in the link in this YouTube video description, or you can see his portfolio in the companies that he's acquiring as well as through his research platform. If you want to earn a lot of money over the long term, it's definitely worth the investment. However, I would say that these 7 rules are fundamental in investing. You need to have the right perspective that a stock is a business component. If the business succeeds, you will too. Most news from those financial TV shows and most YouTubers is basically noise, not news. When you buy a stock, the optimum holding term is forever. Never buy a firm you cannot understand. Be scared when they are greedy, and greedy when others are afraid, and, of course, only buy a stock at a reasonable price. Follow these 7 actually interesting rules, and you will surpass most investors. Thank you from Cash Street, where cash is always king.